Boeing stock fell 4% Thursday morning. President Trump had just announced China would buy 200 American jets, the first major order since 2017. Wall Street had been expecting 500. But while investors fixated on the missing planes, a single line buried in China's Ministry of Commerce statement revealed something far more consequential. The United States agreed to guarantee the supply of aircraft engines and components to China. That clause matters because China doesn't just want Boeing planes. It needs American engines for its own aircraft. The deal came together in 72 hours. On May 13, trade negotiators from both countries met in South Korea, not Beijing, not Washington, but neutral ground. They hammered out 5 preliminary agreements before Trump arrived in Beijing the next day to meet Xi Jinping. By the time the summit ended, China's Commerce Ministry was calling the outcomes balanced and positive. Trump called the meeting amazing. But neither side put pen to paper. Every commitment remains preliminary, subject to further consultation on details that haven't been finalized. Here's what actually got agreed to. First, both countries will cut tariffs on products of equal scale, meaning the reductions have to balance out, dollar for dollar. Second, they'll create 2 new bodies, a trade council and an investment council, forums where each side can air grievances about market access. Third, they'll dismantle some of the non-tariff barriers that have choked agricultural trade, the automatic detention of Chinese dairy products entering the U.S., for instance, or the refusal to recognize avian flu-free zones in Shandong province. Fourth, they'll expand two-way agricultural purchases through those mutual tariff cuts. And fifth, the aircraft deal. China commits to buying planes, and the U.S. commits to keeping the engines flowing. That last point is where the asymmetry becomes visible. Boeing needs China. It's the world's largest aircraft market, projected to double its commercial fleet by 2043. Losing access from 2018 onward handed Airbus the near monopoly. Airbus delivered plane after plane while Boeing watched from the sidelines, frozen out by a trade war didn't start but couldn't escape. Getting back in is existential for the company. But China's dependency runs deeper. The engine clause exists because China's domestic aircraft program, the C919, relies entirely on Western engines. The plane is built by Comac, a state-owned manufacturer positioned as China's answer to Boeing and Airbus. It entered commercial service in 2023 and has won hundreds of orders from Chinese airlines. But every single one flies on engines made by CFM International, a joint venture between General Electric and France's Safran. China has spent billions trying to develop homegrown jet engines through the Aero Engine Corporation of China, established in 2016, but the technology remains years away from certification. Without American and European engine supply, the C919 is grounded. So when Trump announced Boeing's 200-plane order, he was describing one side of a transaction. The other side, the guarantee that GE will keep shipping turbofans to Comac, didn't make headlines, but it's what China actually needed. Beijing can live without new Boeing jets. Its airlines have thousands of Airbus orders in the pipeline, and Comac can theoretically fill some domestic demand. But it cannot manufacture a modern commercial jet engine. That dependency is structural, and it just got locked into a formal agreement. The deal also exposes how preliminary everything remains. China's Commerce Ministry used that word repeatedly in its Saturday statement: preliminary outcomes, preliminary arrangements, still consulting on details. Nothing has been finalized. Both sides are moving quickly to lock in the results, according to the ministry, but until the specifics get written down, which products face tariff cuts, which barriers get dismantled, how many engines GE commits to deliver, the agreement exists only as a framework. Trump's mention of a potential 750 planes if China does a good job underscores how conditional the whole structure is. Investors understood this immediately. Boeing's stock didn't just fall because the number was 200 instead of 500. It fell because the deal was vague, unfinalized, and contingent on negotiations that could stretch for months. The last time Trump struck a trade deal with China, the Phase 1 agreement in January 2020, Beijing committed to buying $200 billion in American goods over 2 years. It never came close. By the time the agreement expired, China had fulfilled less than 60% of its purchasing targets. This time, Wall Street is pricing in the gap between what gets announced and what actually happens. But the engine guarantee is real, because it solves a problem China cannot fix on its own. Boeing gets market access. China gets the one component it can't build. And the deal everyone is calling balanced starts to look like a trade: planes for propulsion.